All right, hope all is well. Guys, this is our latest installment of the real estate masterclass with our lender, Weston from Loan Biz. So we're just going to go over a light Q&A. Weston's going to catch us up with what's current in real estate as of October of 2024, where he sees the future of things going, and just how things are in the interest rates and politics are impacting the real estate industry from his end. So Weston, just quick introduction, who you are, who you work for, how long.
Sure. Absolutely. Yeah, no, appreciate you having me, Steve. Again, my name is Weston Odell. Our company is loanbids.com. We're a commercial mortgage brokerage. We work only with real estate investors. We're pretty much nationwide. All the major states, I think we're in 42 right now. So we can pretty much touch everybody across the country. If not, I can refer it off to the right program. But yeah, so I've been doing real estate brokerage on the financing side for a little over 6 years now, same company, and really kind of seeing the industry evolve from a very small sector, kind of an unknown lending source, to a very prevalent, and it's got a lot of traction, loan options for real estate investors. So again, it's all non-owner occupied. You can't live in it. And the best part is that it's all asset based. So we're looking at the investment itself and the borrower, really from a business perspective, not a personal income perspective. So company's located here in Springfield, Missouri, but again, we're doing stuff nationwide. So that's kind of us in a nutshell. Happy to jump in any deeper into any of that kind of stuff, but yeah, that's what we do.
Gotcha. So what are your typical loans? Is it more fix and flip, more buy?
Sure.
You're buying.
Yeah. So I'll kind of start with our normal borrower, right? We see all kinds of borrowers, but our normal borrower is just kind of the average everyday guy who is trying to build a rental portfolio. Maybe on the side to start. They may have a job currently, but they're interested in real estate. They may have 0 deals up to 30, 40 properties, and they're just trying to scale. So the loan programs that we offer these guys are going to be a fix and flip, definitely. So buying distressed properties, 1 to 4 units is that single family or residential space. That's what we do the highest volume in. So just buying those properties that need renovation, providing funds for acquisition and rehab. And then once that product's done, again, these guys are generally keeping these properties under a portfolio. And so we then refinance into a 30-year fixed business purpose, what's called a DSCR loan, where we just underwrite cash flow of the property, and it has to be in the LLC name. So that's kind of the normal client. I've got a lot of guys that just do fix and flip. They buy them, rehab them, sell them. That's totally fine too. A lot of turnkey guys just buying properties that, just go straight to that 30-year fixed product. And then a few guys that are doing ground up, whether they keep it or sell it, see both are there. So ground up 1 to 4 unit. And then a couple other asset classes we do see would be multifamily, so 5+ unit, bridge or long-term. And then commercial real estate was pretty cool there for the past 18 months or so, but we're starting to see a few more deals come in for your retail, office centers. Those are going to be only long-term stabilized products. The short-term capital for renovating a retail center is just not our lane. It's just hard to get the placement done there. But those are going to be our main asset classes. Again, fix and flip, 30-year fixed, DSCR loans definitely are our 2 highest volume programs, and then a fair amount of ground up and multifamily with some commercial trickled in.
How long are your typical fix and flip or buy and hold terms on average?
Yeah. So that's all going to fall under like the bridge product, right? So generally it's a 12-month interest only loan. That's probably, 95% of the loan programs are 12 months interest only. If we are looking at some new construction, some of these programs will bump it out to 18 months or potentially 2 years interest only. The longest I've seen for a bridge product is going to be 3 years. That's a unique situation if you need anything longer than 2 years. But yeah, your standard fix and flip, 12 months interest only with no prepayment penalty. So the idea of it is just velocity, right? It's the ability to do as many deals as possible. So although you have 12 months, I think the ideal situation is to be out of that within that 3 to 6 month mark. And so that kind of brings up another thing would be seasoning, right? Like how quickly can you exit that? If you're in, I've got guys, my really high volume guys that are doing multiple deals a month, they're able to, buy these distressed properties and they're not total burnouts, right? These are properties that are just, they need $40,000-$50,000 worth of work, primarily cosmetic, maybe a roof and some siding, but they're not redoing the whole thing. They're able to get these properties done in 2 months, 3 months. We start that refinance process right away and get them out of that interest only product into a 30-year fixed loan. Generally, we're able to put a little capital back in their pocket on the cash out, and then they're able just to scale their business and do 2, 3, 4, 5 deals a month at that pace. So that's the other beauty of it. These products are all institutional. So whereas if you've worked with a commercial bank, with their in-house products before, they're going to have exposure limits. So they're going to say, yeah, we'll lend to you under your LLC name, but you're going to have a $2 million, $3 million cap as far as how many deals you can have with us on their books. These are all institutional products. So, it's billions and billions of dollars. You're not going to ever cap them out. You can hit 10, 15, $20 million and just keep rolling as far as loans go. So yeah, I mean, that's general term time. DSCR loans will kind of jump into those as kind of that next loan product would be 30-year fixed. That's the big thing, right? So it's business purpose, close under your LLC name, 30-year fixed, fully amortized loans. No resets. There are ARM options available. Right now, we're just not doing any of them because the pricing is literally on top of the 30-year loans. So it's 30-year fixed. As of today, where are rates? Mid high sixes, low sevens for 30-year fixed, business purpose. We just got to make sure that rent payment covers your payment on the mortgage. So that's kind of it in a nutshell. What do I need to touch on more there, Steve?
Fix and flip. Currently in October, what are the interest rates looking like on some of those?
Sure. Yeah. So right now, I tell pretty much all my borrowers, whether you've done 50 deals or it's your first deal, your rate's going to be like 10 to 12%. It's bridge money, it's short-term capital. Has it been lower in the past? Yes. But this has kind of been the norm for the past 2 years is that, where we'll see 30-year loans, those rates will kind of fluctuate with the treasury market. That's not as impactful on the short-term money. So it's interest only 10, 11%. It's kind of that normal deal. We're starting to see a little bit of softening on that. The Fed rate cut did not impact those to any extent. And then in regard to the 30-year loans, bond prices actually gone up since then. So we've seen rates increase. But yeah, I mean, that's kind of the normal rate range for your fix and flip products.
Would you consider these products still? There's a term people use in the industry, hard money. Is that still kind of what you guys are associated with?
I would definitely consider it. I like to tell everybody there's a lot of ways to get a deal done. Hard money, I think, can mean whatever you want it to mean. I am totally fine with calling these loan products hard money, right? There are, if somebody brings me a fix and flip loan, a property that needs renovation, there's a handful of ways to fund it. You've got, fund it with cash, fund it with a private investor, a doctor down the road that can lend you, they can write a check for it, no questions asked, right? That's going to be probably a little higher interest rate, easier underwrite. You can go with a bank. They're going to be a little heavier underwrite. Their rates are going to be maybe a smidge bit better on short-term money, right? So banks are probably 8, 9% right now on short-term money. And then you've got this institutional space, which is going to be, I like to kind of see it as like a middle ground, right? It's not, when I think hard money, I'm thinking 13, 14, 15%. That's definitely out there and usually comes with more flexibility. Maybe no appraisal, just, close in 2 days. That's out there. The institutional money, I think, is a really nice blend between, bank and competitive pricing on bridge and true hard money. So yeah, call it hard money, call it private, call it institutional, whatever you want to. It's just kind of that middle ground. But the main thing is that it's predictable, it's reliable, and it's scalable, right? So you're not ever going to, you don't have to worry about is the bank going to lend to me this time, or is that private investor down the road, has he funded somebody else's deal and he can't fund this deal? This money is always there, no matter what time of the year, and we can just keep funding loans. So that's the main thing behind these products.
Okay. So what are some of the primary risks associated with hard money lending for both the lender and the borrower?
Yeah, yes, like in this space that we work in particular.
Mhm.
Sure. So the risk from a lender's perspective, we'll start with that. They're going to be as risk adverse as the property allows. So what we're going to do, how do we underwrite it, is ultimately what the question boils down to. So we're going to do evaluation on the property. Generally, that means an appraisal, right? And that's the biggest factor. So we're looking at the asset. What is it worth today? What are you buying it for? What's it worth? The borrower always provide that scope of work of the proposed budget. So we look at that and then we say, okay, based on this X number of renovation, $50,000 or whatever it may be, what is that ARV going to be based on that? And the appraiser is going to tell us that. It's third party, arm's length. We order a local appraiser and they're going to tell us today's value. They're going to look at the budget and they're going to say, based on this, here's ARV. So that's the asset side, right? And we're going to say, if you're buying it for 100, go ahead.
For the appraisal, real quick, what are the appraisal rates going for right now, residential and commercial?
Oh, great question. Fix and flip, or let's just say, because fix and flip and DSCR are pretty similar. We're seeing 1 to 4 unit properties somewhere in that, I'll say $700 range, because it is ordered through an appraisal management company. So yes, you're going to pay probably $150 more than if you were to order it direct with an appraiser, right? But you're also getting, on a 30-year, you're getting a 1007, which is a market rent analysis. And then we're also getting the ARV side. So it's kind of like a two-sided report, but $700, give or take. It can come in cheaper than that. I just don't ever want to promise somebody it's going to be $500 because it's probably going to be a little bit more than that.
Gotcha. And that's on residential. Commercial tends to be higher, right?
Yeah, commercial, I'm trying to think. I just had a 19 unit. They paid like $6,000 for an appraisal. Commercial appraisals definitely have a premium on it. If you're buying a 6, 7, 8 unit, probably 2,500, $3,000, somewhere around there. But yeah, I mean, appraisers are not overly backed up right now. There's pretty good turn times. We're seeing residential stuff come back in within a week from inspection to report completion. So. And I'd say the other thing to note is really we're having pretty good luck with values. So, it is, again, totally arm's length when we order these appraisals. Generally, we're kind of in the margin of that the deal still works when we're getting these appraisals back. We're getting some high ones every now and then, but I'm not seeing, a decrease in prices by any means. So that's always promising.
Okay. What are your typical approval process and how quickly can a borrower?
Sure. Yeah. So we kind of jumped into the asset underwriting from a borrower side. Let's kind of jump into that. And this is, we'll start with fix and flip specifically. So again, on the asset side, it's valuation, it's today's value and ARV. That's what we're looking at. From the borrower side, we're looking at borrower experience being the number one indicator of risk. So we're looking at first-time borrowers. Inherently, there's more risk to that loan than somebody who's exited, a dozen projects in the past couple of years. So lenders definitely take that into account. We're going to definitely close an LLC. It has to be business purpose. We could do a corporation or some kind of other entity, but it is business purpose. So we're looking at who owns that LLC. Does the borrower own 80%? Okay, let's look at how many deals they've done. If that borrower, again, has done 9 deals, you're going to get more leverage. So you're going to get generally 90% of purchase price, 100% of renovation cost. for that standard renovation loan. A first-time borrower, we can get 90%. It is available. It is definitely going to be a little more deal dependent. And so that's what we do. When a borrower comes to us, we always run through, okay, let's look at the project. Is this a heavy renovation, right? Was this a burnout and they need 200,000 of rehab, or is this a $30,000 cosmetic? We look at that. We always ask the borrower about experience, rental zoned, rehabs completed, et cetera. And then we do always ask, just like, where's your credit at? We're not underwriting to borrower credit, or, we don't care about debt to income. We don't care about employment. None of that matters, but the score is an indicator of risk to an extent. If somebody inherently that's got a 760, there's less risk than somebody who's got a, 620 credit. Can we do a 620? We do them all the time. It's no problem, but there's going to be risk. There's going to be steps taken on the underwriting side to mitigate that risk. So either maybe let's see some reserves. Let's see some cash in the bank. Can you bring a partner on? We want to see some good yield on the project. But those are all things that, myself and our team, we account for whenever we catch that deal up front, because some programs are, they're adverse to low credit, or they're adverse to low experienced borrowers. So we just want to make sure that when we get that deal, we're placing it on the right program to account for all those different underwriting risk factors. But again, yeah, it's business purpose. So there is a personal guarantee on the loan. You're just signing on behalf of the LLC. Typical turn time, that's kind of another big question on the fix and flip loans. I would say, like, the average fix and flip closing timeline is going to be like 3 to 4 weeks. If we have a situation where we need to close quicker, it's definitely available. We just need that's going to price differently, and this is going to be a different program than your best price, best leverage, loan program that's going to take 3 to 4. But can we close deals in a week? Sure. You just need to be prepped that your rate may be a little higher, or your leverage may be a little bit lower, because that underwriting is just going to be a little quicker. So that's general, fix and flip outline there. Anything else you want to jump into on fix and flip, Steve?
Just the fees that borrowers can expect to
Sure.
pay
Yeah. Yep. So I would say the general fee structure is like right around 3 points on the deal. That's of the total loan amount. Again, rates 10, 11%. The appraisal is the only thing you pay up front. So you pay that directly to the appraisal management company. But whenever, we cash that deal, I'm always going to provide that fee breakdown before we even do an application. So a borrower comes to me, we run over property address, purchase, rehab, ARV numbers, experience, FICO, et cetera. Maybe any soft spots that they foresee. And then I'll provide them, based on all that, probably 2 or 3 different loan quotes, different programs. We'll walk through, here's the strengths of this program. Maybe here's a potential soft spot on this one. And then definitely pricing. So points, processing, underwriting fees, all of that will be accounted for in the initial. Another big thing to account for is it interest on that total loan amount? Is it, 10.75 on the total loan, the total life of the loan, or is it a drawn funds product, Dutch or non-Dutch? So that's another thing. But again, we account for all that up front before we even start the process. Last thing we want is, late in the game changes. We don't want borrowers, thinking they're going to pay a point, and then it comes to be 3.5 points or something. So we nail that down up front, but loan amount is kind of the driving factor there. So minimum loan is technically $50,000 on a fix and flip. So you can buy those really low $15,000 properties. Your percentage is not going to be a 3-point deal on a $50,000 loan, right? It's just going to be a minimum fee of probably like, 2 or 3 grand, something like that. Whereas if you have an $800,000 loan, you're probably going to be closer to like 2.5 points. So yeah, it's just, it's deal by deal, but we always want to be, upfront with our borrowers on our pricing before we ask them to even fill out an application on something.
Gotcha. So once the borrower is approved, if you could just, briefly touch on how the money's distributed. Some people who've never done this before think
Sure.
they might
Yeah.
check up front and then you're at your, it's at your
Yeah,
disposal.
no, great question. Great question. So this is again, fix and flip specifically. Whenever we're in the underwriting process, that borrower is going to provide a scope of work. We'll send you, a template you fill out. It's generally line item by line item, of just kind of like what you'd expect a contractor to quote you, demo, roughing, all that kind of stuff, right? And that's how the funds are reimbursed on a draw schedule. So as you complete the work, you request draws from your escrowed rehab funds. So if it's a $40,000 budget, you close the loan, that 40,000 will be set aside in a escrow account through the servicing company. And then let's say first things on let's just keep it simple. First line item is, demo and dumpster, right? So it's $1,000 for a dumpster and 2,500 for your demo work. You have to have those items completed before you can request that, $3,500 from your escrow account. So, get the dumpster on site, get your demo done. Once that's completed, if at that point you said, hey, I want to draw my allocated $3,500 per my scope of work, you essentially request a draw. And usually that means going online into the servicing company's portal. You'll have your own login and we'll help you get all set up. And most programs right now allow for what's called like a snap draw, or just like you take pictures of it with your phone, upload them kind of like an app to the portal there. And then we're seeing draws, like my personal favorite program, they're releasing wires same day on those draws. So you take that picture, the reviewer will say, okay, yep, there's a dumpster there. The property's obviously demoed. Great, release the wire for the 3,500, goes right to your account. There also another kind of thing to note on draws is you can take as few or as many of those as you'd like. There is usually a draw fee associated for each draw for that wire fee and the reviewer's time. So, it's probably 150 bucks, give or take, for, depending on program, for each draw. So definitely account for that. Most of my borrowers are floating these on, like a credit card or something, or their Home Depot account for material, or whatever it may be, right? There's 100 different ways to get it done, but it's funded after the work is completed. And so you just do that through the process. That's how these lenders ensure that, because again, they're lending off that after repair value. This is how they ensure that your project gets to that after repair value, is that, yes, the work's done, here's your money. Work's done, here's your money. And then you just, repeat that through the process there.
So when I've done deals with you guys, we've had live people come out and inspect. Are you seeing a change and a shift in that?
Yeah. So some programs still require the in-person. They'll have a local, I hate to call them an inspector. It's usually just a third-party vendor who will come out and take the pictures for you. But I would say over the past, couple months, we've really seen a big shift. I think that the main thing is that the technology is there now, and we've seen lenders adapt that and have success with it. So it's generally an app you download that'll like geolocate you, because they want to make sure you're actually taking pictures of the project that they lend on. So you just go out there and you just select, hey, 3 or 4 line items, and you put a picture correlating with each of those line items. And next day, same day or next day, funding on those.
Nice. So this is the segment I like. This is the current market trends. And I tell a lot of my students in the academy, like, when you have hard money brokers, always lean on them for information, right? Because their job is to broker many deals in many states. So I always pick your brain, from time to time when I decide to come out to the market, like, what are the hot markets? What markets aren't trending? What are you seeing? So what trends are you seeing in the lending space, especially in the current state of the real estate market today? October 2024.
October 2024. I'd say the biggest, we'll kind of start with the problem, right? So the biggest problem right now is it's not interest rates, it's not availability of capital, it's deal flow, it's finding deals. So Borrowers that find a good deal, no problem. We'll close it. Like they fly right through. Sellers are generally very amenable to like getting deals done as well. But it's finding, whether it's through a wholesaler, whether it's direct to seller, whether it's MLS listing, finding those deals is the bottleneck. Where am I seeing success is going to be guys that are getting out there and making offers. Because it's not a situation where, you know, if you're an MLS buyer, if you're buying stuff on the market, it's not a situation where those properties are listed at a good price in most markets. You know, there are some markets where they'll pencil just fine. A couple that have come to mind, some Indiana markets, they're listing stuff and it's like, hey, maybe it's 5 or 10K high. I've got borrowers that'll write 2 or 3 offers, they'll get one accepted, and it's a slam dunk deal. Detroit, I'm seeing some of that depending on the neighborhood. It's wrote a pre-approval for an individual who's buying one for, I think it was like 90,000, and ARV was close to 200, and they just needed a little light rehab. So you can definitely find those on market deals. It is very market dependent on if they're even reasonable based on the listing price. But I would say just don't be afraid to write offers, right? The successful investors are making 10 offers and they're getting 1 or 2 of them. And they find an agent that can do that for them. Wholesalers is kind of that next thing. We do a lot of wholesale deals. Obviously, those are great if you've got a good wholesaler. We can fund 100% of a wholesaler's fee within that, right? So we'll look at that A to B contract and then the B to C, and we can fund them whatever that percentage is. I just need to know up front. And it has to obviously value for that. There are some wholesalers that I see that are asking crazy prices for stuff. So, you know, that's kind of normal. Other than that, direct to seller, like that's great. It's just we don't see many borrowers that are doing the direct to seller thing at scale. It's usually kind of a one-off. Hey, they knew somebody, they picked up a deal. Obviously, it's usually a home run. So that's the bottleneck. What am I seeing that's works from like an investment strategy? Fix and flip is really hard. And I think there's a lot of risk associated with it. The deals that I don't want to say, you know, go south, but the borrowers that, you know, get in a tight spot are usually the ones that are trying to just buy that, you know, that middle ground property, medium value, and renovate it. Their renovation budgets usually come in higher than, especially for first, you know, for newerish borrowers. They may try to buy a $300,000 home and they think 50, that 50 turns into 120 to get it up to, you know, market value. And then, you know, they're lucky to get out of the deal. So I think that's tough. Ground up, I think the ground up space, if you can find the lots at the right price, are great. Just those infill lots, whether it be build to rent or build to sell. I think the new stuff, the new construction, like C-class properties, the lower income, first time home buyer stuff in a good area, it sells quick. That's kind of nationwide. So I like that.
What's that product going for? Where does it start?
Very similar to fix and flip. It's structured the same as a fix and flip loan. The main thing is that the experience requirement, the barrier to entry is a bit higher. Most new construction lenders want to see that you've, you know, at least done a handful of fix and flips, or have new construction experience under your belt. But we're doing a lot of those. So we just need if I've got a first timer, it's got a lot of liquidity, strong credit, and they want to do a new build, we can get that done. But if it's your first deal and, you know, borderline credit, borderline liquidity, maybe a new construction is not the best place to start. But yeah, same interest rate range, 10, 11, 12%, something like that, 80 to 90% of your project cost. And again, we can do that pretty much anywhere. So what else?
So with the rise in the current interest rates, are you seeing a slowdown on the fix and flips? How long are they staying on market? New construction, same thing. You guys are done. Are they selling pre-construction? Are they taking months or years to sell after? What's that home price that's like, all right, this is a base hit. This one's a little difficult. Like what are you seeing out there?
Sure. So the new construction space, if it's and it's so market dependent to put like a dollar amount on it, but that upper mid spec home,
Well, give us a city that you might have just worked on without giving us like exact detail or
yeah,
address.
yeah, sure. So we'll start with like a home run deal. There's a few suburbs of like Birmingham, Alabama that are high end, right? Homewood and areas like that. It's very competitive. So
I'm
happy to
hearing
like
great
show
things
it.
about Alabama also. Is that a
Yeah,
place
for
that's like
sure.
on fire right now?
Alabama is so diverse from like a market perspective. You can go buy a $50,000 almost turnkey property, or you can go do. I've got a borrower that'll build. They'll do ground up, or very heavy renovation in these select neighborhoods, and they'll have resale north of $1 million. They'll do $300,000 rehabs, and then they're all in at 700-800, and they're making 200 or 300K on these projects, and they're usually pre-sold. So that's a very like niche area.
Mhm.
That you can do that. That is not, I'm not seeing that pretty much anywhere else. Even your like step below that, your, $600,000-700,000 spec home, those are sitting in most areas, right? Like you're probably going to have a 90-day market time to sale on something like that. Um, but you know, you're kind of, let's say like in Birmingham or something like that. Let's take kind of just a major main city, nothing crazy, not New York. Your $200,000 single family or $150,000 single family, if you're able to build it for that, that's a 3-bed, 2-bath, or even a 2-2.
Mhm.
Those are selling, right? Because it's affordability. That's the biggest factor for home buyers, right? Whether it be a first timer or just kind of your normal earner, they're not able to afford a $400,000, $500,000, $600,000 house in most situations. And if they are, they're wanting usually square footage, which comes with an older product, generally, not a new build. So I like this. I like the lower grade stuff. There's not as much margin on your $200,000 spec home, but it's scalable, right? You can do that, and you can reliably offload those products. Fix and flip again. I've got some North Carolina markets where they'll move pretty quick. I've seen some borrowers have success there. I've also had them, borrower bought on the wrong side of town or just a little too far out, and they sit. So I think there's definitely more risk there. The safest place, getting back to kind of like the risk thing, the safest play where I see repetitive success again and again and again, and definitely by far my most successful borrowers, from a deal flow, but also from a financial perspective, are going to be guys who are buying D and C class single family homes, maybe even 2, 3, 4 units, but your almost 100-year-old homes, maybe, if you can buy the little newer, great, but your properties that have not been updated in 30, 40, 50 years, buying those, doing a renovation and refinancing them and keeping them as a rental. Rents are holding strong in most Midwest rental markets, and this is kind of across the Midwest, and even some Southern and definitely Northern. Um, they're holding strong enough to cover payments, even at a 7% interest rate on that refi. And most of my borrowers are getting out of these deals with having zero of their own dollars in there, right?
Mhm.
So even if their down payment was, let's say they had $25,000 for their down payment and closing costs to buy it, they're going to get, 30 or 40,000, or they're at least breaking even. They're at least putting their down payment and closing costs back in their pocket. They own the asset. They may be at 75 or even 80% leveraged on that new value, but their rent is going to cover their payment. They're not making $600 a month in net cash flow, but they're making $200, and they've got another asset in their pocket, and they're just doing that again and again. So definitely the safest. Like, I think that is the way to, not short-term wealth. It's not gonna make you rich in a year, but in 5 years with appreciation, principal pay down, and rents, right? Like, I think that's a hard model to beat.
Gotcha. So we should have touched on this in the beginning, but is there any fee for your services in the sense of if I have a deal, or am I
Sure.
paying something up front to you or?
Yeah, great question. So how do we get paid as a broker in the deal? We get paid only at closing, only if the deal funds. And like I said, that pricing, we're wholesale pricing. We're closing north of 100 loans a month right now. So we're wholesale pricing with all of our different lenders and programs. So when I quote you something, the origination, let's say it's 2%, that is generally our fee on the deal. And again, there's no lender fee because we're doing so much volume on these programs that they want us to keep sending them, and that's how the mortgage industry gets volume, right? It's through brokerage. So yeah, the origination fee, we don't hide it. We don't hide our fee. That's how we get paid on these deals, is at closing through the title company. You're not sending any money to me direct. It's all, on the HUD at closing, but we quote that on every single deal. So DSCR 30-year fixed, playing for a couple points, probably 2% of the loan amount. And then fix and flip 2 to 3%, depending on the deal. So yeah, we only get paid at closing, nothing up front.
Got it. Perfect. All right. So last question.
Yep.
This is for Skype Academy students. So what advice would you give our Academy students, first-time investors who are considering hard money loan for a real estate project?
Yeah, for a first-time investor specifically, I would look at a lot of deals. I would probably even buy in a market that you're local to. You can buy out of state, that's fine if you've got good people there. But I like local markets where you can see the asset. You probably have a little more insight into the neighborhood specifics because it does matter. And then I would just review maybe a dozen deals. I'm happy to make myself available as a resource, and I'm sure within the academy, you guys can bounce deals off each other. But I just wouldn't be afraid to look at deals, make offers, and just review as many as possible. A lot of my investors, what they'll do is they may find a project that they like and they think's a good deal. They can call me on that and they can say, hey, here's what I can buy it for. I've got a estimated rehab at X amount, and we'll just run through that before they even get it under contract, just to make sure there's no soft spots that they didn't see. So I think bouncing that deal off, 2 or 3 trusted sources, to make sure that it is a viable deal, and really look at the numbers. Like, okay, I can buy it for this. Here's ARV. What is the what's the expected exit on this project? Is it I'm getting a bunch of money back, or is it I'm breaking even? And both are okay depending on the scenario. But you just gotta look at the deal. You gotta understand where your buy box is, where your market is, and you gotta write a bunch of them. You really gotta get yourself out there, and you gotta make offers, look at projects, and do some reviews.
Gotcha. All right. Well, I appreciate
Yeah.
the time. So understand, if you're one of our students or you're someone watching this on YouTube, we're going to have the way that you can get in touch with Weston and Loan Biz. So we'll have a link directly to Weston, and then you could actually upload, it's just some preliminary details of your project, and then he'll get in touch with you, and then you guys can go from there. All right.
Absolutely.
And with Weston.
No, I think that's it. I would just say, happy to review as many deals as it takes. I understand it. I don't expect the borrower to get a first deal under contract. It may take 10, 12 deals before we get something. It's a long game here. So we're happy to help however we can.
Appreciate that. All right, Weston, this concludes our interview here. This is going to be loaded inside the masterclass, so you'll have access to all our students once they finish their real estate course and they start to, partake in their endeavors. So currently now this is only for US investors, right? You don't fund out of country investments currently.
So yeah, the property does have to be in the country. I can get you a list of the exact states that we can fund, and it's all the major ones outside of a couple. And then as far as the borrower goes, US citizens, obviously totally fine. And then we can work if you've got a foreign national friend or client, we can work with them as well, but the property itself does have to be in the States.
Appreciate you clarifying that. All right, so that concludes it. Everyone's going to have access to all of Weston's information and the actual link to submit an actual offer. All right, Weston, thank you for your time today. And I guess we'll have a follow-up 2025 just to kind of get an update.
Absolutely. Thanks, Steve.
All right, appreciate you.